The topic of this presentation is rethinking correlation diversification by design. And correlation is definitely something that has become increasingly important as people have started to focus more and more on diversification in their portfolios. As has been said, fixed income has done a great job at diversifying risk assets for the last 20 years or so, but all of a sudden, a lot of people are looking at their portfolios and they see this fixed income shaped hole that they're looking to fill. So people are asking sort of how they can do that. I did start with an example of why diversification is desirable and what can it do? It can actually do some surprising things. And this is one of the more contrived counter examples that I could find. And here I have two assets, asset A and asset B, that over the course of 11 years, they both lose money. So you think, what can I do with that? And you'd think the answer is not much, but actually if you combine the two of them and you have 60% of one and 40% of the other, the overall portfolio actually makes money. And it feels kind of amazing, right? It feels like an alchemist turning lead into gold. We've taken these two assets that individually on their own aren't very impressive, but the overall portfolio actually didn't do too badly. And that's the power of diversification. It can do some quite remarkable things within portfolios. It can make relatively modest building blocks add up to something quite substantial. Now, I will admit I had to look pretty far and wide to come up with this example. It is very contrived and is entirely reliant on some of the nuances around compounding returns and volatilities, etc. But it sort of sets the stage for some of the surprisingly important benefits that diversification can have. We can move on to something a little more realistic, something that looks a little more reasonable. And here I started out with 10 markets, and these markets all individually, they're okay. They generally go up. They should have broadly a positive return over time, but we can build a portfolio from them. And this portfolio is really simple. It's just an average, an equal weights to all of those markets. And you can see that the portfolio actually does pretty well. It does better than any of the constituent markets themselves. You're much better off trading this diverse, balanced portfolio than you are any of the individual components. That seems to be a pretty good idea, so we'll press on. We can move now to 50 markets, and now things are starting to look really interesting. So we have, again, these modest building blocks, these individual assets that, sure, they go up, but they don't do anything spectacular. You blend them together, and that blended portfolio is much, much better. At risk of gilding the lily, we can go to 100 markets, and now things look amazing. We've got an almost straight line from the bottom left to the top right of a chart, what everybody looks for. We've seen that we've been able to produce this super portfolio from these individual assets. So diversification, even in a slightly more realistic setting, can really do something quite impactful. Now, when you see something like this that looks too good to be true, it nearly always is. And I'm not the first person to have noticed this by any stretch of the imagination. A very, very famous man, probably the preeminent grandfather of quantitative finance, Harry Markowitz, noticed exactly this way back in the 60s when he was working on ultimately what would lead to his Nobel Prize. And he said that to reduce risk, it is necessary to avoid a portfolio whose securities are all highly correlated with each other. That makes perfect sense. I'm not going to argue with that. 100 securities whose returns rise and fall in near unison afford little protection than the uncertain return of a single security. So what he's saying there is that if you've got 100 things and they all look the same, then you're not going to get that much benefit. But we just saw an example where 100 things looked amazing. So what's going on here? Well, something I guess neglected to mention is that when I generated these assets, they weren't real assets. I made them up, and I made them up in such a way that they all looked different to one another. They were all uncorrelated to one another. They all offered diversification to one another, not the most realistic of simulations. What happens if instead of them all being totally different, we make them look a little bit similar to one another? We're going to inject a little bit of similarity, a little bit of correlation, and we're going to rerun the experiment, and we're going to see if Markowitz was correct. And unsurprisingly, for a man that won a Nobel Prize, he is entirely correct. I repeat the experiment with 10% correlation between the components. 10% is not a very big number, But if we rerun the experiment with a 10% correlation, we see that our amazing prior trajectory that looks so good, all of a sudden we lose most of the benefit. In fact, the portfolio now isn't better than its constituents. It looks distinctly average. So what we've seen is that diversification and correlation can be very, very helpful. It can really enhance returns. However, what giveth can also taketh away. And if you misestimate correlation and often have more of it than you think, it can really undermine returns in a portfolio as well. So it's quite a fickle thing. Now that's unfortunate, because correlation, which is how most people seek to measure diversification, it's very well referenced. It is very poorly understood. This is how most people think about correlation. So correlation is this really important thing. We saw the difference between 0% and 10% is really, really important. So you want to get it right. And this is how most people think about it. They think that on the left here, things with positive correlation, they tend to go up or move in the same direction most of the time. Things with zero correlation, there's no real pattern. They tend to move in their own way. And then things with negative correlation, they tend to move in opposite directions. So pretty straightforward stuff. Unfortunately, everything I just said is not true. While this is a sort of commonly held belief, you can come up with examples where these things no longer hold. So here's a first one. Correlation, when you calculate it, the first thing you do is you take out the long run average, and that can do some weird things. So on the left-hand side here we have two assets, one goes up and one goes down. So you think, right, they move in opposite directions, so they're negatively correlated. No, in fact, their correlation is 80%. They're actually very, very highly correlated to one another, even though they move in opposite directions. The reason is that when you calculate that correlation, you're subtracting the long-term trend. So the one that goes up a lot, you take out that upward trend. The one that goes down a lot, you take out that downward trend. You look at the deviations around that long-run behavior, and actually they're very similar. So they go up more than their trend at the same time. They go down more than their trend at the same time. And that gives them a positive correlation. But that would surprise a lot of people when they looked at that chart. Similarly, on the right-hand side, you can kind of see where this is going. Here we have two things that both go up. They're moving in the same direction, so they're positively correlated. No, in this case, there's actually no correlation between them. They're going up at different times. A way to think about this would be you could have a price that went up on Mondays and one that went up on Wednesdays. They're both going up, but they're never going up at the same time. So correlation and market direction can often be quite counterintuitive. And that's unfortunate, because both direction and correlation are very important. So whenever you see a correlation, you should always check to see that the things are moving in the same direction that you would expect them to. Another issue with correlation is that it measures a very specific type of relationship. It measures a linear relationship. That means you can have things that are very, very closely related. In fact, you can have things that are completely dependent on one another, but they still look uncorrelated because there's no linear relationship between them. So here we have an example of that. Here we have two things, X and Y. They have a perfect relationship between them. It makes that nice curve. Y is completely determined by X. But if you look at their correlation and you run it through Excel, you're going to get a correlation of 0. And that's because there's no linear relationship between the two. Now in finance, lots of things are non-linear. So lots of things may look unrelated because their correlation is 0, but all that's saying is there is no linear relationship between them. So sometimes you have to look beyond these simple summary statistics to understand what's going on. This is actually a very common interview question. It's been asked for years, and people come up with all sorts of different examples for it. I was asked it many years ago. My answer was to draw a circle, which is acceptable. There are lots of other weird and wonderful ways you can answer it. But what you see here is that to get that value, to get these high values of correlation, things have to be very close to a straight line. Correlation is looking for linear behavior. Another one, I think most people understand this one, is that correlation is not causation. Things can happen coincidentally or have happened coincidentally. It doesn't mean that one is predictive of the other. The way I was taught this at school was that as ice cream sales increase, so do the sales of sunglasses. They are positively correlated, but one is not causing the other. There is some external variable, in this case, it being nice weather, that's causing those two things to increase, but they themselves do not necessarily have a predictive relationship of one another. So separating correlation from causation is important. There are loads of examples on this. There are whole websites devoted to weird things that have positive correlations but are clearly unrelated. I picked this one at random. There is a very strong positive correlation between people who drown falling out of a fishing boat and the marriage rate in Kentucky. I guess you could maybe try and extrapolate something from that, but in general, if you look far and wide, you're going to find stuff that looks like it has a positive correlation and it looks like there should be some causation. It's not, it's just luck. You look enough places, you'll find something. So you have to be very careful to make sure that what you're seeing is actually real and not just some chance artifact of the data. So that's a brief segue. And I hope it didn't get too arcane, but for something that is so important, correlation can be a little bit tricky. And I think it's good when you're presented with a correlation number to just sort of ask where could things have gone wrong? Is it that mean has been taken out? Is it a nonlinear relationship? Is it that I've looked at 100 correlations and this one happens to be significant and that's probably just luck? I think these are all important questions to ask as part of some sort of due diligence process. Another challenge is that the world doesn't stay still. Nothing is stationary. And correlations ultimately, when it comes down to it, are an average. And averages can sometimes mask how things change. So we mentioned earlier about stocks and bonds. Stocks and bonds have had a fairly negative correlation to each other for about the last 20 years. But prior to that, they were positively correlated. And prior to that, they were negatively correlated again, and so forth and so forth. Markets go through cycles, they go through regimes. Correlations aren't static. They don't stay fixed in one place. They can change slowly, like they have done in this case. It's ebbed and flowed over time. Sometimes correlations can change very quickly. This is correlations as measured at the beginning of last year. And, there was kind of a lot going on in Q1 of last year. And we can see how correlations change significantly. We saw correlations that in January were fairly close to zero. By March, all of a sudden, everything was positively correlated. It didn't matter which asset you were trading. Everything was going up or down, mainly down, at the same time. Diversification disappeared. Correlations all went to one. So the correlations changed in the matter of a couple of weeks, and that has real implications for the level of risk and how people construct their portfolio. So these things never stay static. It's just a question of how quickly or slowly they're going to change over time. Annoyingly, sometimes these changes aren't independent. Often you see correlations change during periods of stress. We saw that in Q1 of last year. That's particularly unfortunate because it means you can have two assets that most of the time may look different and you feel really good about having these two things in your portfolio. And then when times get difficult, they both struggle simultaneously. Uncorrelated assets have a nasty tendency to all lose money at the same time. And that's because things are more likely to move together at some points than others. We saw this in 2008, right? With mortgages, they all went wrong at the same time. Even though someone in California should be different than someone in New York, and should be different than someone in Florida, when there's this big thing, everything comes into line. So this conditional correlation that's dependent on a particular market environment, is a really insidious form of risk in portfolios, because a lot of the time you don't see it and you may not know it's there. But it can come and bite you, and it typically does so at the worst possible time. I think it's a really underappreciated form of risk. So I've said how correlation is important, and I've also spent a fair bit of time criticizing it, right? And I don't want to be one of those people that criticizes things and never offers an alternative suggestion for how you can think about things. And I will say that if someone held a gun to my head and said, Edward, how would you think about measuring diversification? I would probably choose correlation as the best of an okay bunch of things. But given the choice, it wouldn't be the only thing I would look at. There are other ways you can start to think about things moving in sync or things moving in opposite directions. And correlation is a good one with all the caveats that we've just covered, but there are other things that one can look at. In the bottom left, I've got conditional correlation. We just spoke about that. So not correlation all the time. I kind of don't care about all the time. I think more it's about correlation when you need it. Does this thing look different when I need it to look different? I think that's an important question to ask. So focusing on those times specifically can be quite illuminating. Jumping around a bit, but in the top right, we've got the beta. I don't love beta. It's correlation with extra steps. It's correlation plus volatility. That means if it changes, you're never quite sure which of the two things, the correlation or the volatility, is changing. Personally, I like to separate them. But in general, high betas are high correlations and so forth. So that's another measure that people use. In the middle, we've got convexity. This is a sort of a variation on the conditional correlation. This is one a lot of people look at. They often seek things that exhibit positive convexity. What they mean by that is they want things that make money when markets go up, and they want things that make money when markets go down. So they want positive correlation when markets are increasing, and they want negative correlation when markets are decreasing. And that's why you get this nice kind of U shape here. So that's another nice way of looking about things. It's also asking that question, is this thing doing something good for me when I need it to? So it's a variation on that conditional correlation, but it's a nice way of representing data. A logical extension of that is let's only really focus on the bad times. So that's why you see a lot of the time people focus on returns in crises. It's like, in a year when equities are up 15%, I'm not so concerned about this thing in my portfolio, but what if stocks are down a lot? Is this thing going to help? So that concept of a crisis return is another extension of this conditional correlation. Does this thing help me when I most need it? And then you can move on saying, does it help me on average, or does it help me every time? Those are very different things. Something that makes you 5% every time markets go down is a very different proposition than something that every now and again makes you 50 and other times makes you 0, and people will value those two strategies quite differently. So how it gets there is also very important. So there are lots of different things that one can look at and that one should look at, because they all have their pros and cons. Rarely is sort of one convenient summary statistic enough to tell us everything that we need. I'd be remiss without speaking a little bit more about fixed income. Fixed income's had a charmed life. It's done two things very helpfully over the last 20 years. It's diversified, as we said. It's also gone up. To have something that's appreciated over time, but also made money quite consistently every time equities go down, really is quite an exorbitant privilege. It's very, very, very unlikely that can continue. You can see that the downward grind in yields just can't go on forever. It's going to reach a floor if it has done already. So the positive return from bonds is far from assured. Then as rates start to rise, there is a lot of historical evidence that negative correlation, that negative beta, that diversification benefit, that starts to dissipate as well. So the two things that bonds have done well for the last 20 years are looking very shaky sitting here today. I think one of the interesting things about diversification is, given how important it is and how impactful it can be, we've all been a little bit complacent about it. I think because we've got it generally by luck, right? Bonds have produced it in a passive way. People haven't had to focus on it that much. And so all of a sudden that's changing. I think it's happened more by accident rather than by design, because of the somewhat unique properties that fixed income have had. Without that, all of a sudden you start having to find diversification from somewhere else, and there aren't all that many other places to get it from. I think this is where systematic strategies, and shamelessly talking my own book here, I think systematic strategies have a little bit of an advantage, because we can codify specific behavior. We can build diversification into a strategy. It won't be down to luck. It won't be subject to that up and down oscillation that we see, for example, in fixed income. The rules will dictate that a strategy has to be diversifying. So I think that can make it more of a linchpin in portfolios, because that behavior is explicitly by design. That's something somewhat unique to systematic strategies because of the rules that they follow. So how do you do that? Well, there are lots of things you can try and do. Some are more successful than others. A very common way is that people trade more stuff. Now, more stuff isn't enough to get you diversification. Diversification needs different stuff, and more doesn't necessarily equal different. And I ran an experiment to check that out, and I took a whole bunch of different assets that we could trade. I chose 120 or so different assets, and these range from the S&P and crude oil and gold to Tokyo rubber futures and milk futures in New Zealand, some pretty exotic things. And then I started building a portfolio where I started with the most liquid market, the biggest market, which is the S&P. And I said, right, what if you have one asset in a portfolio? What does that look like? And then I added another and another and another. And as you start adding markets, yes, performance gets better. That's exactly what we saw in our simulations earlier. However, there gets to a point around about 50, 60, 70 markets where adding in more things didn't make it any better. And that's because the stuff we were adding looked like what we already had. So we could add in some more equities, but they look just like the equities we had. We could add in more commodities, but hey, look, this year commodities have all just gone up at the same time. It wasn't giving us anything new. Just trading more stuff doesn't mean that it's different. Doesn't mean it's idiosyncratic. So sometimes just adding things doesn't help. You have to add the right things. Another way of visualizing this is through looking at the correlation matrices between them, these kind of heat maps on the right-hand side. The 50 markets and the 120 markets, they kind of look the same, right? That the big blocks of red are the same. It's still got the same structure. We're not adding anything really innovative just by adding more markets. So you have to be careful that when you're adding something, it really is what you want to add and what you need to add. The same is true of strategy. So what's true of markets also applies to strategies. If things are positively correlated, there is a very diminished utility to adding them. You know, we saw in our example earlier that 10% was enough to cause problems. Look at some of these numbers, 80, 70, 60. You get very, very, very diminished utility from adding these things. I will say my rule of thumb has always been 40% is the approximate cutoff for something being able to add value from a correlation perspective. That is a very soft rule, I will say. It's not gospel by any stretch of the imagination, but a kind of useful rule of thumb. And a lot of things are much more correlated than that. As a result, when you add them together, you don't really get that benefit so much. You can start to build it in, and that's important. It's what we were talking about earlier. You know, you can start to make strategies that by design try and have diversification. A very common way to do that is market neutrality. So people will say, I don't want to look like stocks. A great way to not look like stocks is to go long some stocks and to go short some others. And then they kind of cancel out that general theme. They don't have any exposure to the overall market. That is a very sensible thing to do. It is also very difficult to do. I think of risk in portfolios as a bit like a balloon, that people tend to squeeze it out of one place. It doesn't disappear. It just sort of bulges out somewhere else. It has a nasty habit of reappearing in places that you least expect it. So in the case of these market neutral portfolios, people may try and squeeze out one exposure, the market, but they introduce another risk. It could be an exposure to growth, or it could be an exposure to inflation or something like that creeps into these portfolios, and they're just exchanging risk. It's quite hard to destroy it. So these portfolios make a lot of sense on paper. They're much more difficult to do in reality. And I think a theme of the last couple of years is that these market neutral portfolios haven't been as neutral as people were expecting. But it's definitely a step in the right direction because it's a deliberate decision to try and build diversification into a portfolio. At the end of the day, I think it all starts with objectives, right? You have to think what it is that you're trying to do. And I think when you're designing something, this is very, very important. I think it's essential for people to be pragmatic. Maybe not a popular thing to say, but a lot of the time people come to me like, oh, Ed, I'd love something that makes 20% every year and makes me 30% every time markets go down. I'm like, yeah, I'd love that too. That doesn't really exist. Typically, if you want something that does really well when a lot of markets go down, it doesn't do so well the rest of the time. There's a sort of trade-off between your long-term return and your sort of crisis return. Insurance costs money. Now, how much money depends on what it is you're trying to do. But I think it's important to start to establish early on with people what the objectives are, and then you can appropriately set expectations for what's achievable. I think if objectives aren't set and expectations aren't managed, then it can end up with people having portfolios that are just really not well designed to do what it is that they are trying to do. And I think sometimes it's the hardest conversation to have. Framing the problem takes a frustratingly long time. And you don't feel like you were being as sort of active as when you're trying to solve the problem, but ill-defined problems tend to lead to bad portfolios. So letting people understand that there is a cost and a benefit to diversification is important. One way we've tackled it is we've tried to combine different parts of portfolios that should work at different points in time. So this idea of getting sort of structural diversification into a portfolio. So we built our quant macro strategy. And our quant macro strategy, for example, starts out with a carry piece, and carry is designed for when markets are very quiet. So when not much is happening, we have carry in the portfolio to make money. Then some piece of news comes along, right? Some piece of new information comes out and it causes the market to move. So we have a fundamental model that analyzes hundreds of different pieces of data and it tries to detect that event when it happens. Then the market does move. Markets aren't super efficient. So rather than having that jump, which is what it should have done, there's a trend to catch up. So we have a trend piece in the portfolio to ride that market move when it happens. And then finally, prices always get a bit carried away. They go further than they should. They come back. So to capture that, we have this value or reversion piece in the portfolio. And we get diversification, yes, through the assets that we trade, but also how we trade. And said, each of these pieces is designed to work at a different point in time. So trend is divergent. It's betting on prices moving away, whereas reversion is convergent. It's betting on prices coming back. They kind of can't be correlated. That the diversification is built into them by the nature of the rules that they follow. Carry is for flat markets, whereas the fundamental models are for markets that are about to have this big move. So we build it in by explicitly using different rules for different parts of the portfolio. You can do it through risk management. You can make it an objective. As we saw earlier, correlations change, volatilities change. If you can build into your portfolio this notion of modifying positions and modifying exposures to try and maximize the diversification or to achieve a diversification objective, that can really help things. So, whereas in March of last year, we saw that assets were really positively correlated, the positions that we held in those assets weren't, because we were able to go long some, short others, and spread that risk out to make sure we were able to maintain a broadly consistent level of diversification within the fund. So by making it an objective of strategies, you can help be sort of the master of your own destiny. You're not so subject to the whims and the vagaries of the markets themselves. Finally, you can really, if you really want to go for it, you can impose an explicit constraint. And we do this in some accounts that we do, and some managed accounts where people have come to us and they said, cap exposure to something. For example, people might want to constrain the exposure to equities. And this is a really interesting one. So people say, Ed, I want a version of your portfolio that doesn't have equities, because they look at, say, the rolling beta of our portfolio to equities, and over time it's zero, but it's never actually zero. Like sometimes it's positive and sometimes it's negative. And that's because ideally we're going long markets when they're going up and we're going short markets when they go down. So they say, okay, well, we don't want to ever have additional exposure to equities. Can you do something about that? Can you not go long equities? And I say, sure. And we diligently do that. Interestingly, that actually doesn't eliminate your exposure to equities. And that's because there's other stuff that looks like equities. Right now, commodities look like equities. Sometimes FX looks like equities. You have to be a bit more careful than just not trading something, because you get this kind of hidden exposure. So we can actually impose a constraint in our portfolio that says, never give me equities exposure. That actually does cap it out. That means you get a portfolio that is never exposed to equities, either directly or indirectly. That's quite an aggressive constraint to put on a portfolio. People do it, and I think it has an important role. It's always something I'm open to exploring with people, but that's the type of thing that in a systematic strategy you can do. So this strategy is never going to surprise you by having a positive correlation or a positive beta to equities. You can see that the worst it ever got was 0. It never went positive, and we can do that by design and by imposition of some rules within the portfolio. So that's kind of it. Just wrapping it up. The diversification, very, very important. It can make portfolios a lot better. I think much better than people realize. It can smooth them out. It reduces volatility. It can enhance return. Generally makes life a lot more straightforward for everybody. Diversification, however, it's hard to find and it's hard to measure. People often use correlation. Correlation is very much imperfect. I think people have often come unstuck by measuring correlation improperly. So it's important when talking about diversification to make sure that you're really getting it and that you're measuring it correctly. I think it always helps to ensure that the diversification that you have seen historically is going to persist into the future, that you have a well-defined objective in your portfolio, and that you have components where it's not just down to luck, but it's inherent in the way that they operate and it's structural to those components themselves.